Hello everyone and welcome to today's video. Today's topic is focused on creating a simple debt amortization table. So what I mean by simple are a couple things. Number one, we're only looking at one tranche of debt. The minute you start adding in additional layers of debt, so senior debt and then junior debt and maybe a preferred security, things can get more complicated very quickly. The second thing that I'm assuming that's going to make my life a lot easier is no additional debts getting layered on the business mid-year. There's no revolver that's happening. It's a very simple, straightforward calculation of the business generates free cash flow. 100% of that free cash flow goes towards paying down debt. In the event the business loses money, new debt is taken on at the same terms as their existing debt to cover it. The other thing I would say for anyone who's new to financial modeling, I would not start with this video. There are a lot of simplifying work I've done here that if you are familiar with the key terms and methods you use to model a company, you're going to feel pretty comfortable with when you see them. But if you've never worked with an actual financial model before, seeing things like a free cash flow or net working capital, I'm not really going to explain what any of this is or how you would calculate it because that's not relevant to what we're focused on today. So I would start with a different video in the fundamentals section of this channel. All right, so let's get started. First thing we want to highlight are what are the debt assumptions. We're saying the principal balance is $300 million and the interest rate is 8% annually. We've got some assumptions around the free cash flow. The one that we're going to focus on right now are the tax rate of 25% and the minimum tax expense of 0. Just flag that in your mind for now because we're going to come back to it when we integrate the debt into the model. But step one is just creating the table itself. So as you can see, we've got everything we need to get to free cash flow, including the free cash flow already set up in the model. What we're going to do now is create a debt amortization table. The purpose of this table is to track the company's debt over time and see the way that the free cash flow affects the amount that gets paid down every year and what our interest expense is every year. This is very commonly used in a leveraged buyout model, but it would also be used in any kind of model where you have interest accruing over time and the debt is allowed to be paid off as the company wants. Some debt instruments say you're not allowed to pay early or there's a penalty if you do. Again, that's more complicated than what we're looking for at this point in the video. So, first thing we need is beginning debt. Then we are going to add in new debt that is taken on, which in this example would only be if the free cash flow for debt paydown was negative in a given year. Then the other thing we're going to do is take out debt paid down, which would just be the positive value of free cash flow in a given year. And then we get ending debt. Now, just for 2019, we are going to assume that at 12/31/2019, so right at the end of the year, they took on $300 million in debt. So no interest accrued here. And this is just the new debt balance that will feed the table. The second thing that we're going to assume is that interest is calculated based on the beginning balance of the debt at the given year. What does that mean? Some quick formatting here. Again, I'm skipping through explanations of some of this formatting as this relates to topics we cover in a different video. And this is focused on a very specific component of a model. All right, so we've got the beginning of the debt table set up. The next thing we need is to figure out our interest expense. Now, when we're not using average interest, it's a very straightforward formula. You take the beginning debt and multiply that by the annual interest rate, which we are just going to anchor. Now, before we start integrating the free cash flow into the debt table, what we are going to do is integrate the interest expense into the model. And to do that, we're going to need to turn on circular reference. The way we do that is we go to File, down to Options, click on Formulas, and then click the box that says Enable Iterative Calculation. So from here, what we're going to do now is take this interest and add it back into our income statement, as this interest expense will reduce free cash flow through the cash interest component, but it will also reduce the amount of taxes we pay by reducing our taxable income. So let's take a look at what that would look like. We take our interest expense and add it in. Now, as we can see, the base for cash taxes has declined, and as a result, so has our estimated tax expense. So while we have more debt on the income statement, and net is going to be a negative impact to cash flow, we still are reducing some of our tax expense. Then the next place we're going to add the interest expense in is in the free cash flow itself. So now we have the balance that is going to either be subtracted from debt every year because that debt is paid down, or added if it's negative. In this example, every year they're paying down some of their debt, but let's show you the way to build in if the cash was positive or negative. So let's start with debt paid down, because this is going to be easier to see right away. We are going to use an if statement, and it is if the free cash flow is positive, so greater than 0, then we are going to take the negative value of the free cash flow. Why do we do it this way? Well, we want this number to be negative because right here we are summing up these cells. If we were just doing something a little more deliberate, we could say plus this, minus that, but we're going to make it a sum because that's just easier. Now, if it isn't positive, for now we'll just set it equal to 0. And we drag it across. The second thing we're going to do is build in the part of the formula for if there is new debt on the business because they generated negative free cash flow. So it's a very similar formula to the cell above. If this cell is less than 0, now it's the negative value of this cell. Otherwise, it's 0. So why is it negative even if the value is negative? Well, it's because if this were, let's say, negative 15.7, I want it to show a positive here, again, because we're summing this up. Now, one thing you'll see after integrating pay down into the model is the interest rate declines, or the interest expense rather, declines over time. So the more debt we pay down, the more benefit we get to our business because we've got more cash to pay down the principal. So this is a simple debt amortization schedule. I'm going to show one additional item you could do to this to combine one of the formulas. So let's say we make a slightly more complicated debt amortization schedule where we have beginning debt and ending debt, but we want to have these two rows combined. So plus / minus new pay down. So in this situation, the first cell doesn't change. Again, I'm moving a little bit quicker here, simply because I'm assuming you have at least fundamental understanding of this model before excluding the debt table, of course, versus if we were working on one of my more fundamental videos. So now what we're going to do is we're going to say if this number is positive, so greater than 0, then we're going to use a negative value, the same formula as this cell. The one thing we're now going to flip is instead of saying if that is false, it is now 0, we're going to say if it's false, it is now negative free cash flow. What does this formula mean? So it means right now, because cash flow is positive, we're taking it out of the debt. We're subtracting. But if this were negative, we would then be adding it in. It's the exact same formula as above, but it combines these two rows. Now, why would you do one versus the other? One advantage to doing it this way, where you have new debt here, is you might, in a certain year, both generate positive free cash flow, but take out an additional loan on the business. Maybe you're partially refinancing, maybe you just get an extension on your line of credit. There's a lot of reasons it could be. But in that situation, what might be nice to do is turn one of these cells into an input, and then you're able to add in a line while still incorporating the change from the free cash flow. The other thing is, whenever you make a formula longer or slightly more complicated, and this is an example of a formula where it's not that hard to add a little additional complexity, you're always running the risk that you're going to make a mistake and not be able to catch it because you're reviewing a longer and longer formula. For me personally, I prefer this method, but it's entirely up to you. Please reach out to me if you have any questions. These videos are made for the financial modeling class I teach. If you are interested in learning more about that, feel free to reach out to the channel for more information. Thank you and have a great